You know, for a lot of people, the stock market seems, well, huge, really complex, maybe a bit intimidating, especially if you're just starting to think about it.
It definitely has that reputation, all the charts, the jargon.
Exactly. But what if we could sort of cut through some of that? What if understanding the basics wasn't actually that complicated?
Well, that's the idea, isn't it?
Welcome to the Deep Dive. We're your shortcut to getting genuinely informed. We look at a bunch of sources, expert interviews, documentaries, guides, analyses, and pull out the really essential stuff you need.
And yeah, we've got quite the mix today. We've looked at an interview with Guillaume Riviere. He has something like 40 years of experience in the markets.
Wow, 40 years.
Yeah, plus a video from Charles Gave looking ahead to 2025 investing.
Hmm.
And then there's an RTE documentary about how financial markets actually, tick.
Okay.
And for beginners, a really useful guide from Finery, plus a couple of other comprehensive guides just on understanding the market itself.
Perfect. So our mission for this deep dive is basically to synthesize all that, pull out the key insights, the main strategies, so that you, listening, can get a much clearer picture of stock market basics and some ways to approach investing.
Let's do it.
Okay, so first things first, what is the stock market, fundamentally?
Okay, so at its heart, it's really just an organized place, a marketplace for trading financial instruments.
Instruments like,
Well, the main ones are stocks, which represent ownership in a company, bonds, which are basically loans,
mhm,
and ETFs, exchange-traded funds. Think of those as like baskets of investments that track something specific, like an index.
and it all kind of boils down to that classic economic idea, right? Supply and demand.
Exactly. That's the engine. If lots of people want to buy a particular stock, the demand is high and the price tends to go up.
And if everyone's selling.
Then supply is high, demand is lower, and the price, well, it usually goes down. This constant push and pull is what causes those real-time price changes you see.
But it's not just about trading prices back and forth, is it? It has a bigger job in the economy.
Oh, absolutely vital. It's a key mechanism for growth. It lets companies raise money capital by selling shares.
Right, so they can fund new projects, research.
Exactly. Expansion, R&D, new ventures. And on the flip side, it gives individuals like us a place to potentially grow our savings over time.
And when you buy a stock, you're not just getting, like, a piece of paper. You actually own a tiny slice of the company.
That's precisely it. You become part owner, a shareholder. And that can come with perks, maybe dividends, a share of the profits, and sometimes even voting rights on company matters.
It still sounds a bit overwhelming, maybe, for someone new. All the terms, the rules.
It can feel that way at first, definitely. But like our sources point out, once you start to grasp the basic vocabulary and the rules of the game, it becomes much less intimidating. It's about learning step by step.
And it's crucial to understand it's not just gambling, right? There's a real difference.
Oh, a huge difference. Yes, there's risk involved, always in investing. But the stock market is a structured economic system. It reflects what investors collectively think about a company's future performance based on, actual business results and economic factors,
Yeah.
not just random luck.
Okay, so that's what it is. How does it actually work day to day? What's the rhythm?
Well, think of it like a continuous option during specific trading hours. All day long, people are putting in orders to buy or sell.
Mm-hmm.
And prices are constantly updating based on that supply and demand we talked about. It's very dynamic.
What kinds of things make those prices jump around so much? It can seem so unpredictable.
Yeah, it's a mix of things. A big one is the company's own performance, their earnings, revenue, any big news.
Makes sense.
Then you have the wider economy, things like inflation reports, interest rate decisions by central banks, unemployment numbers. They all play a role.
Okay.
And of course, big global events, geopolitical stuff, trade agreements, even natural disasters can ripple through the markets. Central bank decisions are huge too.
And who's actually doing all this buying and selling? Is it mainly individuals?
Not really, no. Individuals are definitely part of it, what we call retail investors, but a very large portion of trading is done by institutional investors.
Like who?
Think big players, banks, pension funds managing retirement money, insurance companies, big asset management firms. And because they trade in such huge volumes, they can often have a much bigger impact on price movements.
So how does an ordinary person actually buy or sell a stock? You can't just like call up the stock exchange anymore.
No, not quite. You need a middleman, a broker.
Okay.
The broker is your access point. They provide the trading platform usually online or through an app where you place your orders. Many also give you research tools, charts,
Yeah,
analysis.
everyone involved kind of has their own angle, their own reason for being there.
Pretty much. Individuals might be aiming for long-term goals like retirement or maybe shorter-term growth. Companies need that funding we discussed. And those big institutional investors, they're managing huge sum for their clients, trying to hit specific return targets based on their mandates and risk levels.
Our sources mentioned investment banks and asset managers specifically. What do they do?
Right. Investment banks often get involved in big deals, like when a company first goes public, that's an IPO, initial public offering. They help set the price and sell those first shares.
That.
Asset managers are different. They pool money from lots of investors, individuals, and institutions into funds, like mutual funds or those ETFs we mentioned, and manage those portfolios.
And you hear about different styles, like day trading versus long-term investing. Big difference there.
Huge difference. Short-time traders are trying to profit from quick price moves, maybe holding things for just minutes or hours, very active, often high risk.
Right.
Then you've got the long-term investors, like the famous Warren Buffett. They're looking for solid companies they think are undervalued, and they plan to hold those investments for years, sometimes even decades, riding out the ups and downs.
Okay, that paints a clearer picture of the players and the mechanics. Let's zero in on those key participants again. Who are the absolute essentials?
Okay, number one, the companies. They're the issuers. They're selling pieces of themselves, the shares, to raise that vital capital.
Got it. Then the investors, everyone buying those shares, whether it's you and me or a giant pension fund.
Exactly. And like we said, with different goals, building wealth, retirement savings, managing large institutional funds.
And we need the brokers, the connectors.
Yep, the intermediaries. They make the trades happen, provide the platforms, the tools, essential link.
And overseeing it all, the regulators.
Crucial. Think of bodies like the SEC in the US or the AMF in France. Their job is to ensure fair play, prevent fraud, and protect investors. They set the rules and keep an eye on things.
Okay, good. Now, what about the actual things being traded, these financial instruments? What are the main ones we need to know?
Well, the big one is stocks, or actions, as they might say in French sources. We've touched on this represents ownership.
Right, owning a piece of the company.
Exactly. Potential for returns through dividends if the company pays them, and capital gains the plus value if the price goes up and you sell. But, and this is key, the price can also go down. There's risk of loss. Volatility.
Okay. Then you mentioned bonds or obligations. Sounds different.
It is. A bond is basically debt. You're lending money to someone, a company or a government.
So I become the lender.
In effect, yes. The issuer promises to pay you back the original amount, the principal, at a set date in the future, and usually makes regular interest payments along the way. Those are called coupons.
Are they safer than stocks?
Generally speaking, yes, bonds are considered less risky than stocks, but the risk level varies. A bond from a very stable government is usually safer than one from a struggling company. It depends on the issuer's creditworthiness.
Gotcha. And the third one, ETFs, fonds négociés en bourse. You said they're like baskets.
Yeah, think of it like buying a pre-packaged basket of stocks or bonds. They trade on exchanges just like stocks. And they usually track a specific index, like the S&P 500 or maybe a sector like technology or healthcare. The big advantage is instant diversification.
So you're not putting all your eggs in one company's basket.
Precisely. And Rouvier actually mentioned that Warren Buffett apparently told his heirs to use low-fee ETFs for passive investing. They often have lower fees than actively managed funds too, which is a plus. Good starting point for many.
Our outline also mentioned things like options and futures. Should beginners worry about those?
Probably not right away. It's good to know they exist, but they're more complex instruments, generally involve more risk, often leverage. Best to get comfortable with stocks, bonds, and ETFs first before venturing there.
Okay, that makes sense. So we know it's traded. What about the underlying ideas, the core principles for thinking about investing?
Right. Well, a huge one, and something Guillaume Rouvier really stressed, is long-term investing versus short-term trading. He talks about focusing on the big underlying long-term trends rather than trying to time the market perfectly for quick gains. He suggests thinking in terms of at least 5 years.
That 8-year figure he mentioned for safety probably ties into that, letting cycles play out.
Exactly. Giving time for the market's inevitable ups and downs to smooth out and for the value of good companies to hopefully assert itself. Trying to guess the short term is notoriously difficult, maybe impossible.
Okay, long-term focus. What else?
Diversification. We touched on it with ETFs, but it's a core principle. Don't put all your money in one place.
Right, spread it around.
Yeah. Across different types of assets, stocks, bonds, across different industries or sectors, even across different countries or regions. It's all about reducing your overall risk. If one area struggles, hopefully, another does okay.
We hear the word volatility all the time. What exactly is it, and is it always bad?
Volatility is just the measure of how much an asset's price swings up and down. It can feel scary seeing your investment value bounce around. But Rouvier had that interesting take, like, using judo, use the force of volatility to your profit. Meaning, those downswings can actually be opportunities to buy good assets at a lower price if you have a long-term view. But yes, higher volatility does mean higher risk too. It cuts both ways.
An expected return. That's just what you hope to make.
Basically, yes. It's the anticipated profit, keyword.
Yeah.
Anticipated. It's not guaranteed. And generally, the higher the potential return you're aiming for, the more risk you usually have to take on.
Which leads us to risk management. How do we protect ourselves?
Exactly. Risk management is about strategies to limit potential losses. Diversification is a big one. Setting stop losses, maybe. But also, crucially, understanding your own risk tolerance. How much potential loss can you stomach without panicking? That's different for everyone.
Okay. And the last principle was correlation, how things move together.
Yeah. It's about how different investments behave relative to each other. Do they tend to go up and down at the same time? High correlation. Or does one go up when the other goes down? Low or negative correlation.
Like your umbrella and ice cream example.
Exactly. Understanding correlation helps you build a portfolio where not everything is likely to tank at the same time. It improves diversification.
All right, principles clear. Now, how do we put this into action? What are some actual investment strategies people use?
Well, a really common one, especially recommended for beginners by Rouvier in the Fine Area Guide, is dollar cost averaging, or DCA.
Okay, what's that?
It's simple, really. You invest a fixed amount of money at regular intervals, say $100 every month, no matter what the market is doing.
So you don't worry about trying to buy at the perfect bottom.
Exactly. Sometimes you'll buy when prices are high, sometimes when they're low. Over time, it averages out your purchase price. You buy more shares when they're cheap, fewer when they're expensive. It takes the emotion out of trying to time the market.
That sounds very practical.
What else? There's value investing. This is the classic Benjamin Graham approach, Warren Buffett's teacher. The idea is to find companies that seem to be trading for less than they're actually worth their intrinsic value. Rouvier mentioned looking for good companies trading below their historical trend line as a potential sign of this. Buying quality on sale, basically.
Okay. And contrasted with that is growth investing.
Right. Growth investors aren't necessarily looking for bargains. They're looking for companies with really high potential for future earnings growth, even if the stock price already seems a bit high. They're betting on rapid expansion.
And just buying the whole market, that's index investing.
Yep. Using those ETFs or index mutual funds we talked about to just track a major market index like the S&P 500. You're essentially aiming to get the average market return. Rouvier noted that's historically been around 8–10% per year, which isn't bad at all, especially with low fees. Passive approach.
Rouvier also specifically suggested focusing on leading companies. Why that approach?
His thinking is that established leaders, he mentioned names like L'Oreal, Air Liquide, Coca-Cola, Google, often have strong competitive advantages and tend to keep performing well over time. Like good students stay good students, more predictable perhaps.
Interesting. Though that contrasts a bit with the arcade documentaries angle, right? They seemed more focused on profiting from volatility, maybe in less predictable areas.
That's a great point. The documentary definitely highlighted a different mindset, seeing volatility itself, even crises, as trading opportunities. Rouvier's approach seems more about stable, long-term compounding with quality companies. The documentary's perspective is perhaps more aligned with active trading or seeking opportunities in faster-moving, maybe riskier parts of the market.
So different strokes for different folks, depending on risk appetite and goals.
Exactly. There isn't one single right way. It depends on the investor.
Okay, good perspective. Now, thinking about beginners again, what are the common pitfalls or mistakes they should really try hard to avoid?
Oh, number one, without a doubt, is letting emotions run the show.
Buying high, selling low.
The classic mistake, getting caught up in the hype when markets are soaring and buying near the top, then panicking and selling when things inevitably correct or crash. Sticking to your plan, not your gut feeling, is crucial.
Easier said than done sometimes, I bet. What else trips people up?
Chasing hot tips or trends. Your neighbor tells you about a sure thing, or some meme stock is going crazy online.
Yeah,
Acting on that kind of stuff without doing your own homework is usually a recipe for disaster. Just because something's popular doesn't mean it's a good investment for you and your goals.
We keep coming back to diversification.
Yeah.
So lack of diversification is a big error.
Huge. Putting all your money into one or two stocks or even just one industry. If that one thing goes bad, you're in serious trouble. Spreading the risk is fundamental.
Makes sense. And finally, just sort of setting it and forgetting it entirely. Is that a mistake?
Well, underestimating the need for ongoing learning and discipline is definitely a pitfall. Markets change, economies change, you need to stay somewhat informed. And discipline ties back to emotion, sticking with your strategy, even when it feels uncomfortable.
Okay, so we know the do's and don'ts. Let's get really practical. Building and managing a portfolio.
Yeah.
Where does someone actually start?
First step, always. Define your profile and goals. What's the money for? When do you need it? How much risk are you truly comfortable taking? The beginner's guide really stressed this. Your answers shape everything else.
And the guide also said start small.
Yeah, excellent advice. Don't feel you need to jump in with your life savings. Start with an amount you're comfortable experimenting with. Learn the ropes, gain confidence.
And for that initial diversification, ETFs seem like a good bet.
Yeah, for many beginners, using broad market ETFs is a really sensible way to start. You get instant diversification across hundreds or thousands of companies, usually with low costs. Takes a lot of the guesswork out initially.
What about maintaining it? Do you just leave it alone then?
Not quite. Regular rebalancing is important.
Rebalance it.
Over time, some investments will grow faster than others. Your initial mix, say 60% stocks, 40% bonds, might drift to 70-30. Rebalancing means selling some of the winners and buying more of the laggards to get back to your target.
Ah, so it forces you to sell high and buy low, in a way.
Exactly. It imposes discipline.
And reinvesting dividends, you mentioned that earlier. How powerful is that?
Incredibly powerful over the long term. It's the magic of compounding. Instead of taking the dividend cash, you use it to buy more shares. Those new shares that earn dividends and so on. It snowballs.
It really sounds like patience is maybe the most important virtue here.
Absolutely critical. Investing is a marathon, not a sprint. There will be downturns. There will be periods where your portfolio goes down. You need the consistency and patience to stick with your plan through those times.
Rouvier also had that specific tip about having cash ready. What was the logic?
His point was, keeping some cash on the sidelines gives you dry powder to buy when opportunities arise when the market dips, or a great company's stock falls for temporary reasons. He also suggested maybe trimming positions when things seem overheated, building up that cash reserve. It's about being ready to act when prices are favorable.
Let's dig a bit more into Guillaume Rouvier's specific insights. 40 years. That's a lot of market cycles. He co-founded ibu.expert.
Yeah.
What's that about?
Yeah, ibu.expert is basically a platform he helped start to give individual investors access to the kind of in-depth financial analysis that usually only big institutions get, trying to level the playing field, help people make more rational decisions, especially with European and some big global stocks.
He made that strong claim about stocks being the safest investment long-term, specifically after 8 years.
Yeah, that's based on his analysis of historical data. His point is that over longer periods, the growth potential of stocks, especially with dividends reinvested, has historically outweighed the risks and beaten other asset classes like bonds, even factoring in the volatility. That 8-year mark is likely where he sees the probabilities strongly shifting in favor of stocks historically.
And he aims for alpha outperformance at IBU, trying to get 11–13% returns. How?
Right, alpha means beating the market average. His approach seems to be, first, focusing on companies they can really understand deeply, mostly established European leaders, and some global giants. He mentioned being wary of trying to fully grasp companies in very different cultural contexts like Japan or China.
Okay.
Second, deep fundamental analysis. Looking at the company's intrinsic growth potential and comparing its current price to its historical valuation trend, that regression line. Buying good companies when they look cheap relative to their own history.
He also agreed with dollar cost averaging, which seems interesting for an active manager.
Yes, he sees it as a sound method for individuals to invest regularly and avoid the pitfalls of market timing, complementing a long-term strategy.
And he really hammered home knowing your stocks well. The secret is to know 10, 20, 30, 40, 50 stocks well.
Absolutely. His philosophy is deep knowledge of a manageable number of companies beats superficial knowledge of hundreds. understanding their business, their growth, their valuation. He even mentioned having a target return in mind, like needing at least a 15% expected annual return to buy, and maybe selling if that expected return drops way down, say to 4%, suggesting it's become fully valued or overvalued.
What about AI? Does he think it changes everything?
He sees it as a useful tool, definitely. For research, finding data, maybe identifying competitors faster. But he believes human judgment, discernment will always be crucial, especially for spotting things algorithms miss or understanding the impact of totally unexpected black swan events.
Okay, shifting gears slightly. What about Charles Gave's perspective? He talked about real value versus paper money.
Yeah, Gabe's point, using Air Liquid as an example, is about tangible assets and essential businesses. Companies with real factories, global reach, providing necessary products that have an underlying value that's maybe more durable than just financial figures or currency values alone.
And his take on gold. That's valuable because everyone agrees it is.
Kind of a belief-based value. Gold is scarce, historically accepted as valuable across cultures.
Mhm.
It's not based on a government saying it's valuable, like fiat currency, or just company performance, like stocks. It's this shared, long-standing consensus.
And then the RT documentary. It had that different favor. Volatility is our friend.
Right. That perspective is much more about trading, about capitalizing on price swings,
Hmm.
finding opportunities in the ups and downs, maybe even in crises, rather than just focusing on long-term fundamental value.
It also raised that idea of a disconnect between financial markets and the real economy.
A really important point. The documentary suggested that sometimes the short-term incentives and movements in financial markets can get detached from what's actually happening with jobs, production, and long-term economic health. Things that are bad for society might look like good short-term trading opportunities.
And the rise of computers and algorithms in trading was a big theme, too.
Huge. High-frequency trading, algorithms making decisions in microseconds. It's changed the nature of markets. Speed and technology are critical now. It brings efficiency, maybe, but also new risks like flash crashes.
But even with the computers, that psychological element, fear and greed, is still there.
Absolutely. The documentary stressed that. Even in a world of algos, human emotions drive decisions, influence sentiment, and can lead to bubbles and crashes. Managing your own psychology remains key for anyone involved.
Okay, so much to think about. For listeners wanting to explore more, what are some good practical tools and resources?
Loads available now. For brokers, you've got many online options like Robinhood, E-Trade, Schwab in the US, Dejaro in Europe, and others depending on where you are. It pays to compare fees and features.
And for tracking things, getting info.
Tracking and analysis platforms like Yahoo Finance, TradingView, FinViz are great. Lots of free data, charts, news.
What about robo-advisors? Are they useful?
They can be, especially for beginners or those wanting a hands-off approach. Platforms like Betterment or Wealthfront build and manage a diversified portfolio for you based on a questionnaire about your goals and risk tolerance. Automated investing.
And practicing without risk.
Simulators. Investopedia has one, MarketWatch too. Great way to try things out with virtual money. See how strategies work, get comfortable with placing orders, all risk-free. And lots of portfolio tracking apps like Delta or ShareSite help you monitor your real investments once you start.
Any essential books you'd recommend someone pick up?
Oh, definitely. The Intelligent Investor by Benjamin Graham is the Bible of value investing, still incredibly relevant. A Random Walk Down Wall Street by Burton Malkiel gives a good counterpoint about market efficiency and index funds. Maybe The Little Book of Common Sense Investing by John Bogle, the founder of Vanguard. Unshakable by Tony Robbins is popular too.
What if you prefer listening? Good podcasts.
Tons of them. The Investors Podcast is very popular, covers a lot. Choose 5 focuses on financial independence, money tree investing. In French, we saw mentions of Finery Talks and Le Grand Bain. Lots to explore.
And structured online courses?
Yeah, if you want a deeper dive, Yale has a famous financial markets course on Coursera with Robert Schiller. Khan Academy has great free introductions to stocks and bonds. Platforms like EDX, Coursera, Investopedia Academy all offer relevant courses.
Okay, so wrapping things up, it feels like even though the stock market looks complex, the core ideas, the fundamentals, they are understandable. It's not some secret code only experts can crack.
Absolutely. That's the key takeaway from all these sources, really. It takes some learning, yes. You need to understand the basics, the risks, the strategies. But it's accessible. Adopting a methodical, informed approach is totally achievable.
And there's so many resources now, books, podcasts, courses, simulators, to help you build that knowledge and confidence. We really encourage listeners to check some of them out.
Definitely. And maybe a final thought to leave with. In a world that seems obsessed with the short term, with quick fixes, how might adopting that long-term perspective, we talked about the focus on value, on patience, the kind of thing Rouvier and Graham advocate, how might that change your approach, not just to investing, but maybe other areas too?
That's interesting.
What's one thing, maybe one resource or one concept from our chat today that you, the listener, might want to explore a bit further to start building your own informed view of the market and your financial future?